Jason Schenker, who's a president and chief economist at Prestige Economics. Jason, great to have you with us. And so we're sort of in this holding pattern, I guess, potentially for the next 2 weeks, if that is the timeline that President Trump sticks to before making a decision on US involvement. Where does the market go from here? Because as Stephen just sort of outlined some of the worst case scenarios, we're not quite there yet. How do you assign that risk at this point?
I appreciate being here today. This is a really hot topic that a lot of companies are grappling with, and it could impact everything from business strategies to Fed policy and other central bank policies, impacting eventually U.S. inflation, and even, as we just heard, that hot Japanese inflation number that we heard come out. There's all kinds of inflationary risks that we see from higher oil prices. Where we are right now in the conflict, obviously, we're likely to see these prices remain elevated from where they were before the conflict started. We're quite a bit higher than where we were at that point. You know, right now we're kind of in that $75 a barrel range for WTI. If this persists for a few weeks, could go a little bit higher. I don't think we're going to see it go much lower. But the point is, right now, prices would be a lot higher if it weren't for all the trade risks and tariff fears and the recent downgrade to global growth forecasts from the IMF. So one of the key things, really one of the only things that's holding oil prices down right now is kind of a weaker growth outlook and lots of uncertainty around tariffs and trade. If those things get resolved, prices could go up. If the conflict gets worse, or if the conflict system expands to involve the United States, or if then we see somehow oil infrastructure targets become hit, if we see an expansion in the way Iran is attacking Israel and how Israel responds, all of those things present upside risk. The downside risk to prices at this point is, well, if we would see a swift resolution of the conflict and sort of peace breaks out. And I view this as one of the conflict zones of Cold War II. The main first zone we saw start with Russia's invasion of Ukraine. That's not over yet. This conflict still ongoing, and a series of conflicts escalating after you had Hamas attack Israel on October 7th in 2023. So this is part of that conflict still ongoing in the second front of Cold War II, unlikely to end soon.
In the meantime, what sort of expectation do you have from OPEC Plus? Is there any sort of reaction function that we could see here? Obviously, if we're talking about a partial or a full blockade at some point as a worst case scenario, that also limits their options too.
Yeah, I'm much more skeptical about a closing of the Strait of Hormuz. I think then you could see China potentially get involved, because a lot of Iranian crude oil goes predominantly to China. That's predominantly where Iranian exports go. If something cut that off, then a conflict system expansion might not just involve the United States. You could then see China become more actively involved in the conflict in one way or another. So I think everyone wants to avoid that situation, and you can see it in the way the Israelis are targeting very specific assets and targets in order to eliminate the Iranian capacity for nuclear weapons development. That is the very clear objective target that they're working around as a military objective. As far as other risks go, I mean, I think where we are right now with the price action, we could see more prices go up. This is going to be very responsive to daily news feeds of different things ongoing. I would expect prices to remain elevated here, but if this really only lasts a couple more weeks, we could see prices be significantly lower in the fall, especially if we see U.S. Q3 GDP weaken. U.S. Q1 GDP, as you might recall, was slightly negative, minus 0.3%, because of a surge in imports as U.S. importers were rushing to import things ahead of the Liberation Day tariff announcements on April 2nd. So that really hurt Q1 GDP, because when you increase your imports, that weighs on GDP. But because there was a pull forward effect, Q2 GDP could be really big. And if you look at the Atlanta Fed GDP now, the latest numbers from yesterday, June 18th, showed GDP for Q2 is likely to be, based on currently available data, 3.4%. Very positive number, because with a pull forward of imports in Q1, you're going to see a drop in imports in Q2, could see a big GDP number. But by the time we hit Q3, the question is, do we see the U.S. economy slowing more severely? Do we see the global economy slowing more severely? And if this conflict is even a little bit in the rearview mirror, or at least not directly front and center everything we're thinking about, we could see a downside to oil prices in the fall, especially because by then the driving season's over. And the biggest seasonal supporter of oil prices in the world is the U.S. summer driving season. Of course, we're in the middle of that right now. But if we get to the fall, Q3 GDP weakens, economic data weakens, driving season's over, and we begin to see this conflict fade from visibility, there's more downside from oil prices once we get to that period of time.
So much uncertainty, right? Whether it's a geopolitics, whether it's the trade tensions. In this environment, it seems gold continues to hold around record highs. The dollar not necessarily reacting as traditionally we would expect it to. What are the safe havens at this point?
Well, I think gold, folks are looking at that for a number of different reasons. I mean, the geopolitical risk has really pushed folks into that. I think there's currency risks because of all the uncertainty. Econometricians tend to talk about the outlook in terms of a distribution curve. Normally, folks think of, a bell curve as a kind of a distribution. But econometricians talk about kurtosis, and it's one of the things you can see in a distribution. And that's when you get fat tails in your distribution. That means the range of outcomes of rare things isn't small. It's kind of big. And so now you have both upside and downside risks that could be significant in the near term. As I've mentioned, and as we heard from the reporter before me, there's all kinds of risks that could happen in terms of if you saw the closure of the Strait of Hormuz, if we saw different kinds of assets that get hit in this conflict, if there's a conflict system expansion, that's bullish in the near term. But if we look to the fall, there's bearish factors there for price action. If we see further slowing of global growth amidst a high interest rate environment, and of course elevated inflation that could be further impacted by these high oil prices, is going to make it more difficult for central banks to cut rates in the fall, just as growth could be slowing more severely. So you have a lot of risks revolving around all markets at this point. I think gold, that's why gold has been so attractive for investors.
With everything that you've said, what do you expect the Fed to do this year?
Well, I think that we are likely to see the Fed cut. Whether we see one or two cuts will depend on the evolving data. As you might recall, at the May Fed decision in the press conference, Fed Chair Powell indicated they were waiting for data, using the word wait 23 times in his remarks in the press conference. And he said the words wait and see 11 times. I'll be curious to see the full transcript from the Q&A from yesterday's Fed decision, where Fed Chair Powell indicated there was uncertainty. He used that word a lot. And then when he talked about the projections for Fed members, he said there was no conviction around those forecasts. And he said that multiple times. What did they show? The median projections from the Fed members themselves show there's likely to be 2 rate cuts of 0.25% by the end of the year. But the average actually changed. The average went from showing close to 2 rate cuts to now a lot closer to only 1 rate cut. So whether you're looking at the median of 2 rate cuts or the average of 1, it doesn't look like there's going to be too much action in terms of rate cuts by the end of the year. And of course, the Fed is being data dependent.
Jason, always great to have you with us. Jason Schenker, who's the president and chief economist at Prestige Economics.